Welcome to another episode of Coffee with Samso. Today I've got Davide Bosio here from Dj Carmichael, EMD, soon to be Shaw Partners.
Shaw right? Partners, yeah.
David, I normally start just get you to do an intro.
Yeah.
Are you Trinity All Boy, by the way?
Yeah, I am. Yeah.
There you go. Yeah, just give us an intro.
Yeah, absolutely. Well, we're very, very proud in terms of where we've got to in terms of the business. So I've been in stockbroking now since 2001, and over the last few months we've taken Dj Carmichael, which is a 123-year-old West Australian brand and business, predominantly all traditional stockbroking and wealth management, and we've now done a deal with predominantly an East Coast based company called Shaw Partners, who have been around for about 30 years and have built a fantastic stockbroking and wealth management business on the East Coast, and they've looked at us as a terrific opportunity for them to really scale up their business in Western Australia, and for us it's exactly what we need in a larger group that helps us deliver more services to our clients. So it's fantastic. I've been managing Dj Carmichael now for the last 5.5 years, and I'll continue in the role with Shaw Partners as a West Australian state manager. But we've got offices under the new brand and the new business. We've got offices in Sydney, Brisbane, Canberra, Adelaide, Melbourne, Perth, and it's a fantastic business. It just gives us so much more reach, so much more distribution for our clients, and more products. It's terrific. So we're really excited about it.
I mean, we first met many moons ago. I think you were Pareto.
Yep.
Pareto. I can't remember. Mid 2000s, I think.
Yeah, that was
2010.
Yep. Around then.
So obviously you've been in this industry for a long time. I mean, the traditional stockbroking business that probably doesn't exist anymore.
Yeah.
Buy and sell for commission kind of thing. When you look back from your start in early 2000s to now, I mean, what's the biggest change that you've seen?
Yeah, well, I started off in a small derivatives focused firm, and then moved into a large mainstream broker, and that was a fantastic experience for me, and then made the decision in 2008 when the markets were really starting to get affected after the GFC. I wanted to start my own business, and I went out and got my own license and operated as a broker with a smaller firm, and in 2014 made the decision to move back into a larger broking firm, and that was Dj Carmichael. And the reason for that really was, the industry's changed so much. So even over my time, we've got shorter settlement dates. You've got a lot more in compliance. There's a lot more in education requirements for advisors, and all of these things mean that you need more systems and more processes around your business. Compliance we see is a good thing. Education we see is a good thing, but to do it well, it's really hard to do it as a small business. So what I've seen over the course of my career has been a real requirement to really upskill. You need to be more professional, so you need better systems, you need better technology to run your business, and to do that you need to be part of a bigger group. So I found my own journey has been really trying to become part of a bigger business, and with Dj Carmichael now moving into Shaw Partners, it just gives us, as I said, better technology solutions, stronger compliance regime, better products, more scale for our clients. It's what you need, and I think that's where the industry is going. It's just changing, and I do feel that with the regulation and especially education requirements, to stay relevant and to stay in the game, you've got to be part of a bigger group.
I remember in the mid 80s, there was two exchange, and I think the settlement date was like 30 days. So people were buying and selling with no money, really. And today now, I think it's what, one day?
Oh, it's T+2. So a lot of brokers require cash up front. So you need money sitting in an account to allow you to trade. Best case, you've got two settlement days before you have to trade. So even on exactly the same. We used to have a lot of flexibility around settlement terms. Back in the crash, if you talk to brokers who were around in the 80s, particularly October 87 when the stock market had a big crash, well, a lot of firms fell over because clients didn't settle. They had 60-day terms, 90-day terms. They were buying and selling shares without any cash. So when they had to come in to call in their debts, there was no money there, and it created massive problems. So the system's a lot tighter these days, and you can see that the businesses that do exist cannot rely on flexible credit terms like that. Absolutely not. Yeah.
I think the merging into Shaw, it's a positive, more than a positive. It's almost like inevitable that you have to go down that road. Size matters now.
Yeah.
Distribution absolutely matters, and there are people everywhere. And if you can handle that kind of cost structure, probably be the last one standing after time. Obviously, as we all know, the traditional business is non-existent now. Everyone handles sort of corporate deals and things like that.
Yep.
So I think that relationship was very interesting, because around that time, someone else got bought. I forget the name.
Yes, Patersons and Canaccord announced the deal as well in Perth.
Yeah.
So that's a significant size transaction as well. Bringing an East Coast, West Coast flavour together.
Yeah. Moving on to like hot topics, I guess, everyone talking gold now, it's 2200 Aussie, we just had that discussion before, and all the money's flowing into the small sector. I don't think I've seen that. Probably 80s is one, maybe mid-90s, maybe somewhere around there was the last batch of this kind of excitement.
Yep.
Even small raisings was very easily done, and you gave us example of alt resources, because I saw that, and as I mentioned to you early this year, and I was a bit worried that they got a big bill to pay, but they raised all the money, and you've left lots of money on the table as well. You were saying.
Oh yeah, we've raised a lot of money. In fact, it goes, as you know, in our industry, it's never perfect. So it's either you can't raise enough money and you're struggling to find money, or people are throwing money at you and you have to send it back, which is almost heartbreaking. But we've been raising money for gold companies for a long time, really since 2015. We've been actively funding a lot of small gold companies, and it's been hard going at certain times, but it's been very rewarding. And I think we've seen a terrific rally now in the gold price, and I've been talking about it a lot across various media platforms, etc. But almost to the point where you're kind of sounding like that you're that mad person that just keep But the theme is really, really strong, and you look at it as an asset class. The global markets are actually reasonably expensive at the moment, so people can look at blue chips globally or large caps globally, and valuations are reasonably stretched and quite full, which can continue. We're clearly in a reasonably good bull market, but you really need earnings growth to follow and to keep valuations at a reasonable level. Otherwise, at some point, that bubble will burst and valuations will find themselves coming back. So, but what we're seeing is all these, these geopolitical factors. You've got tensions with the US and China. You've got Brexit. In Australia, we had the Aussie election as well, which created an enormous amount of uncertainty. All of these things kind of bode pretty well for a strength in the gold market. You've got, basically negative interest rates. For someone sitting on a lot of cash, if you're in retirement mode, sitting with money in your super fund, it's hardly attractive to have it sitting in cash earning,
nothing.
1.5%. You're really getting nothing, and you have to pay tax on that amount. So the attraction to put that money into the equity markets or the property market is strong. Clearly, markets are, the global decision makers are trying to stimulate the markets, but again, you kind of look at it and say, well, at what point do these valuations get stretched? So we feel very comfortable in that trade, but it's been a hard one, because if you look at the big end of town in terms of producers who are doing well, Northern Stars, Evolutions of the world, those sorts of calibre, Newcrest, St Barbara, there's lots of them that have done particularly well. Their share prices have been quite strong. When you go down a tier to the guys trying to develop assets, or the next tier of producers or the next tier of advanced explorers, there hasn't really been that same uplift in terms of valuation. So the euphoria feels like it's just starting to kind of pick up, and that's what you kind of need to really see, that end of the market.
I haven't seen any flurry of activity in that bottom end of the explorer, even advanced exploration for, comfortably say decades, really. We had like little spurts in there in between, but they didn't really come to anything, really. So, in that sense, it's very, very, it's been a long time since brokers had to give money back, I think. It was always about, there was always a saying, if someone was a give money, just grab it and worry about the consequence later, It's like I used to have a saying about you brokers, Brokers only give you the umbrella when it stops raining. But it's just the industry, there's no money in it. In this bottom end, we're not talking about the industrials or whatever, but in the resource sector. And we've continued to see, as you said, all these producers just powering on,
Yeah, they're going from strength to strength.
Yeah.
They've got, especially in gold, Aussie gold terms, they're selling their metal at 2,200 Aussie.
That's right.
It's phenomenal,
Yeah.
and they're doing that today.
Yeah.
But they're also consuming ounces. So this is the hard part. So you take away the whole economic argument as to why something like gold should continue to rally. The producers are also using up their ounces, so their inventory is reducing.
Correct,
so for them, the economic reward of buying more ounces or discovering more ounces is huge at the moment. So, again, I think there's a huge theme which is on its way if this momentum continues in terms of M&A. We have to see phenomenal M&A or some serious deals happening in the next 3 to 12 months.
Oh, I think I agree. When we had that situation, the majors are powering on, and they will explore within their own space, and then maybe we got to a stage where they've done all that and they realise that there's not much left in their space, and they need to go a bit afar to find things like what you're saying, all the M&A stuff. And anyone that's got half a breath of a mind is probably on target. There's a few of those sitting around,
Yeah, but I think there's still quality. I do believe that right now there's still quality acquisitions. You probably start getting concerned when you see companies take on massive risk in very high risk countries with very early stage assets. That's when you're probably getting a little bit toppy. But I don't think we're there yet. I think we still have a way to go.
Yeah, I agree. There's still the second tier assets that never really make the cut now because of the price rise. Getting a good looked at. And those bigger ones, they still got economies of scale to try and keep the costs down. Standalone stuff, second tier is probably still not quite there yet, in my opinion.
Yeah.
But the ones that can make the grade with the big boys probably.
Yeah. But the good thing is now, companies have got the ability to actually find the capital to help them take it to the next level. Because, as you know, when the markets are tough, it's very hard to find any money. So the money that you are able to raise or to keep in a company really goes towards the most urgent things. Whereas now, even the big companies, they've all come out over the last quarter with quite significant exploration budgets as well. So you can see that they're also saying there's been underinvestment in exploration on good assets that we own. We now have sufficient capital or sufficient risk appetite to go out there and actually do the work, and that's, to me, again, only a major positive for our market.
No, I think for the other commodities, I did one recently with Vince Algar from Australian Vanadium. You sort of see all these guys sitting there with things that are just ready to roll, but the market's not quite there, the capital's not quite there, and maybe this is the sort of the catalyst that the whole industry needs. People to start thinking, wider. Maybe I should take position in this because that could happen, like how this has happened. So I think that's sort of. But moving on to sort of like the tech side, I'm curious. I've got two sectors I like, but from you guys live that industry. Tech, AI against cybersecurity. Those are two big thing in future because everything's going to be cloud based. Everything. What's your opinion on that sector?
It's phenomenal, and I think it's it's hard for us because we're in Australia. We're so isolated, really, from the rest of the world. But if you look to, call it the States, which is the centre of the universe in terms of technology and new technologies, it's phenomenal. Like the growth in those ultra large cap companies, they're just incredible. Is phenomenal, and there's a reason for that. It's the power of AI, the power of the data that they're able to capture, and what it actually means in terms of how companies transform themselves. It's just next level. If we bring it down to our own example, back to our transaction with Shaw and Partners, we need access to better technology solutions. Our clients need access to better technology solutions. This is happening across every business, everywhere. So I think it's just something that's only going to gather more momentum. There's insurance companies, banking companies, fintech. We've seen it. Companies like Afterpay, like Zip Money, phenomenal, massive market caps because they're coming in to disrupt the banking sector. Now, we last week we hosted EFG, which EFG are a major Swiss investment bank. They are a 51% shareholder in Shaw. So again, through this transaction, we now have a big brother via our parent, which is a global investment bank. They have an enormous amount of funds under management. They've got an immense sort of analytical presence as well. So they're watching global moves, which gives us access to some of the things that they're seeing globally. And we had a presentation which was fantastic, and we had 150 clients of ours at that presentation, and we were talking about the key themes in the market, and all they spoke about was technology. So sector one, technology. Sector two, healthcare and technology around healthcare. Sector three, financial services and technologies around financial services. So it's just in everything that they do, and in everything that I think if you ignore that sector, you're missing out on a huge part. The hard part for us, especially being in Perth or being in Australia, is that we are a long way away from some of these companies. You see companies like Atlassian, a fantastic success story in Australia. The two founders there, still in their late 30s, and two of the richest people in Australia now. Phenomenal. But they had to take their company, which overseas, many people have never heard of before, and they've listed on the NASDAQ, and it's been spectacular for them. So it'd be great if we have more of those sorts of examples in Australia.
That's the thing I find, I've been in Perth 39 years and did geology. You sort of incubated in resource, you think that's it. But when you go overseas, everyone's incubated in non-resource. And it's always hard to marry the two. Yep. Sydney sometimes, even though we're in the same country, sometimes the guys over there don't understand what's happening here, the way it's done here.
Oh yeah, Perth is a very different world of its own, and we have high highs and low lows. But in our business, if we weren't involved in resources, it'd be difficult.
Yeah.
But what I think unites us all is the fact that you look at some of the biggest resources companies in the world. They've also got the biggest technology development going on. They've got huge R&D teams. You look at companies like Fortescue, BHP, Rio, driverless trains, driverless trucks. AI in their business is everywhere, and it's only getting it's getting bigger and bigger and more. I've got a client who's got a large trucking business, one of the largest fleets in Australia, and their trucks are like mini computers. It tells them everything. They know everything about it's just really slowly becoming more and more prevalent in every industry, every business. So I think that's one thing that certainly isn't changing.
Like with the AI, I mean, when you mentioned the guys out of Rio Tinto, 3DP Pointera is a company that I've got shares in, but the guys also came out from that driverless truck department, and so I'm sure, like you said, all these big companies who may be in one sector, then someone will figure out what they need, and that will come out. But the other one is also the things like cyber. I like cyber because I think, because everyone, we also depend on cloud now. Everyone says, oh, no, we won't have a computer in the office, we'll have it in cloud. But then it's actually quite vulnerable if you don't have the security there.
Yeah, it's incredibly frightening when you stop and think about it. But also, as consumers, we kind of demand these things. There was a time when we only had a phone on the wall at home, and we seemed to get by. You could still talk to people, you could still communicate. Now, if my computer's not on my phone in my pocket at all times,
you go home to get it.
You feel like you just can't function. So it's frightening, and this is a huge theme. So if you talk about cybersecurity, I think that's without question one of the biggest threats and one of the biggest opportunities that we face probably in our generation, because we've got, I think, people like myself that are still very much dependent on technology, but I still grew up without technology, so
you know what it's like without.
I still remember a world without it. But for our children and for, I guess, a lot of millennials coming through, they are completely, they're on a device. Often they don't even think about the consequences of what it means to leave a digital trail, etc., and to log into a computer anywhere, or just to hand your details over. And I think that's going to be something where companies that are successful in, I guess, protecting us as consumers is incredibly important. But the data side as well is quite frightening to me. When you see some of the big data hacks that have happened and some of the data breaches, these are major things that are out of our control.
Although we know and we talk about it, but we don't actually realise how big it is.
Oh, it's phenomenal. Again, if I talk about the EFG team that presented to our clients, they were talking about one of their funds, which is a product that we've got access to and that our investors have now started putting money into, and that's a US. It's a US focused leaders fund. So basically, they're looking at, call it, small caps and emerging mid caps in the US, which they call that companies over 5 billion. And they're saying these are the growth companies of tomorrow. So they're already massive companies. We don't have many of those in the ASX at all. But they're saying we're looking for companies 5 billion plus that are in emerging spaces, and they're companies, many of which we've never heard of. But we ran through the list. There's the guys behind Grand Theft Auto, as an example, one of the biggest gaming companies in the world. They've made more money from their gaming company than the entire Star Wars franchise. So put that in perspective, something that we all know, the significance of something like the Star Wars franchise, and these guys that built a computer game that I've never played before, they've made more money, and they're a massive company. Now, these are companies that, fortunately or unfortunately, can change the world. They've got so much behind them, so much capital, so much influence. Like they're the guys coming through. There's examples in healthcare, there's in biotech, in gaming. These are things that influence our children today, and those companies have got enormous pull.
I think the gaming companies is the odd one out, the funny one, because you think it's gaming, it's not really there, but they make a lot of money, those guys.
Huge
money.
It's crazy, and there's also gaming, companies now. There are gamers that actually fill stadiums, people watching, guys sitting around playing games, and it's huge. They're big.
And you only get bigger.
You only get bigger. Absolutely.
Because when we used to want to play games with our friends, we all got to congregate one spot. Now I see my son sitting, he's on the phone to them on the computer, and he's playing with another 5 or 6 other friends. All in their bedrooms, and, or anywhere in Perth. And
it's frightening.
And you could be playing anyone around the world, But the last thing I wanted to retouch on, and I'm not sure, you might get your hand spanked for talking about the ASX or ASIC, but lately, I mean, when all this kerfuffle came up with the job table and things like that, and everyone's waving their arms, but I get what they're trying to do. Is just trying to stop the fake stuff and the unjustifiable results and all that. So I get all that. Do you think it's a good thing for the industry? I know it's tightening and making things less sort of flexible and things like that. Do you think it's a good thing for the industry?
Yeah, I've got a view which it makes our business tougher, and it makes what we do harder. But also, again, I'll say to you, there's a reason why we're so excited about our transaction with Shaw and Partners, is that by being bigger and stronger, you can adapt to the changing environment. Now, I think all of these things, it's always hard. So as an example, in financial services in Australia, post the Royal Commission, they've introduced a new education requirement, which means that over the next 3 years, every single financial advisor, stockbroker, anyone advising on retail clients' funds or investments needs to lift the bar in terms of their education. So even if you've been in the industry for 30 years and you're an expert and you've never had a compliance issue and you're really good at what you do, you still have to do more education to get up to a certain level. Now, in our industry, there's been a lot of backlash and a lot of people who feel that's terribly unfair, but if you stop and think, well, that actually makes everyone better. It means the quality of advice and the quality of the experience for the consumer, for the investor, should arguably be a lot better. And I think that can be the same when you talk about ASIC and ASX. It's always hard when there's regulation change, when there's structural change in terms of policies, procedure, but it is really there to try and create a greater level of integrity in the marketplace, so people know that you're a real market and that you're true, and that's really important. The ASX, their job, they're trying to compete with, the Dow, with the Nasdaq, with the London Stock Exchange, with the Singapore Exchange. They're trying to compete on a global scale to have the best quality companies listing on their exchange. And to do that, people need to take them seriously, and that means global investors need to see a company on our exchange and say we like investing in Australia because we know that there's a high level of regulation and compliance. Hard for the small guys because there's a lot more work to keep up, but that's really what they're trying to do. It's to give investors the confidence that anything that's listed on our exchange is managed by ASIC, that they tick all the boxes and they're a real company and they're a good company, and that it's on the best exchange possible. So if you take away the pain of having to comply, if you look at it from that angle, hopefully it creates a better environment that we can do business on. Same as going back to the education example, there'll be fewer advisors in the industry because a lot of people will say, this is too hard, we're leaving, which means that the quality of advisor that stays behind will be a lot better. So for the consumers, I think they're going to get a better result in the long run. People that are in the industry, they really want to be in the industry and they take their profession seriously, and they're going to invest in their education to be the same as you regard a lawyer as professionally qualified, you regard an accountant as professionally qualified. You should see a financial advisor or a stockbroker exactly the same. Like this guy here or this person is a real professional and is going to do the right thing by me with my money, and that's ultimately what it means. In the short term, is there a bit of pain? Absolutely, but I think that's the process. With listings, etc., the ASX have made it a lot harder to list a company. They've tried to really, lift the bar, and I think, again, if you look back in 5 years' time, we'll say that's a good thing. In the meantime, there's a little bit of pain around that, but ultimately, we get used to the new world. We know we have to raise more money, and we know we have to try and get behind bigger companies.
Do you think there's space for more than one board? Because we used to have two. In this kind of regime where ASX can lift their bar, compliance costs. The after effect of this is always compliance costs for the smaller players. The smaller cap people. Do you think there is a space for two exchanges?
Yeah. I think. Obviously there is the second exchange in Australia, and the challenge that they've had has really been around liquidity. I think on the compliance side they seem to be going well, but I feel that we have a small market. Again, if you're in Australia, we consider ourselves to be the centre of the universe, but in the global scheme of things, we represent 2% of, call it, the market. So we're tiny. If you're sitting in a broking firm in Wall Street, you're not considering what your client should be doing in Australia, whether we should be buying an Australian share. We're not on the register, so we are a small market. The biggest thing we've got going for us, our proximity to Asia Pacific. So obviously Singapore, major financial centre, Hong Kong, major financial centre, China, major player, major partner with us. So that's what we've got going for us. My personal view is I think a secondary exchange can exist, but I think they really need to build, whether it be a niche in terms of sectors that they're very strong in, or liquidity. There needs to be seamless liquidity and zero friction for investors. What I mean by that is investors now are used to being able to. Well, when I started stockbroking, the internet was still, there was dial-up internet, and clients had a pretty poor experience with online brokers because it was slow, it was clunky, didn't always work. It could be quite problematic. Today, that's not the case. Internet speed is incredible. Your ability to place orders online quickly is incredible, and that's really what we're up against. As an investor, you'll trade on any exchange provided it's frictionless. So as long as they can get on, trade a stock without having to do a lot of paperwork, difficult in terms of process or being able to tap an order, if they can just log on to an account, place an order, they don't care with the exchanges. So I think as technology maybe catches up in terms of a secondary exchange, I think there's certainly an argument that it could work.
Yeah, I think the seamless part's very important.
Absolutely.
We do all the dealings on the phone now.
Yeah.
When you talk about that dial-up days, is you got to go on a terminal and then do the dialing up and getting onto the internet.
That's right. Well, it was quicker to pick up a phone and talk to your broker.
To your broker, yeah.
Now you can click a button and you can buy and sell so easily.
Yeah. You don't have to worry about whether the broker's on the phone or not.
Yeah.
So yeah, but fantastic. Thanks, David.
No worries, no.
It was good for you to give up your time.
No problem.
And I think there was a lot of things that we could have carried on, but it's good for you to give me some time, and thank you.
No, thanks for having me.
Okay.
Fantastic. Thank you.
Right.